if you look at the history of the stock market, you can unequivocally say that every 10 to 20 years, there's a rotation in who are the big leaders.
It's as much as where we try to derive value as everybody else. So I totally think it would work, especially in Graham's case.
The growth that you're seeing in the company doesn't always translate to value for shareholders. It's not a panacea. All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer some great questions. We got one great listener question, and we got some other ones that we gathered from other sources that will be revealed later. So let's go ahead and dive on in and do the first question. So here we go. It says, hello, Dave. I was listening to the podcast episode on share buybacks, and I have a question. If my goal is growing passive income in the form of dividends, is there an advantage for me with share buybacks? In theory, I will never sell my shares because I just want to receive more dividends year after year. So even if a stock goes up or I get a bigger part of the company due to buybacks, I don't see any advantage in that for my case. So great question. And let's go ahead and dive into this. What are your thoughts, sir?
Let's dive in. I have been called the drip king once or twice in my life. So I'm a very pro dividends person. But I've also become increasingly more interested in share buybacks. Basics of that, if you're an absolute beginner, companies make profits, they get free cash flow from those profits. They can return those to shareholders in the form of dividends or buybacks. Either way, it's a return of capital. It's the company taking their profits and funneling it back to shareholders, the owners of a company. It's just taking two different forms. So yes, the listener is absolutely correct in that if you get it in the form of buybacks, that is cash that you can spend as an investor, or you can reinvest it. And if it's a buybacks, you can't spend a buyback. In that case, the listener is absolutely correct. However, there is more nuance to it than that. And yes, that actually, if you were to take two companies and one was doing buybacks and dividends and one was only doing dividends, as a shareholder, you would still benefit from the buybacks. And we can kind of talk about that back and forth. But just to be clear, when we're talking about these definitions and buybacks versus dividends, that's the gist of what we're talking about and what all of that means.
Yeah, it makes a lot of sense. So what is a buyback? Like a dividend, I think, is pretty self-explanatory. It's money that the company is giving to you. But what is a buyback?
Yeah, buyback basically reduces the number of shares outstanding. Every stock has a certain number of shares, and then everybody who owns the stock has a different number of shares. So what the company does when they buy stock back is they buy some shares from some shareholders, and then instead of the company holding on to those shares, they just retire the shares. And that basically wipes them from existence. That's just the way the mechanics of it work, right? And so what that does is that makes everybody's piece of the pie a little bit bigger. Because if you had a company that was split into 10 slices of pie, maybe now it's split into 9 slices of pie. It's still one pie, but your slice got that much bigger. And that's basically what a share buyback does.
Mm-hmm. Exactly. So what are your thoughts on the pros, I guess, of each? So a dividend versus a buyback for investors.
Well, let's start with the dividends, because that's the one that's I've hung my hat on that for a very long time. Mm-hmm. I'll start with a con, because even the buff dog, he talks about how buybacks are a better tax treatment for people. Mm-hmm. However, what is great about dividends, to me, the best part about dividends is that's cash you can count on. That's cash you can take to the bank. And so even if, because one of the arguments against dividends is like, oh, well, the buyback will make the stock price go higher. And so you just sell that little bit. So like going back to our example with the pie, if you had 1/10 of the pie and now you have 1/9 of the pie, you just sell the shares until you have 1/10 again, and then you take that money as income. That is a very great idea in theory. In reality, the market is irrational. And so depending on where you are in the market cycle, you might be selling those shares at a time you don't want to because the stock is depressed. Vice versa, you might sell at a great time. But that's the benefit of a dividend over a buyback is in order to get cash, I don't have to sell low to get that cash. The dividend's coming, I can count on it. Whether it's a recession and stock prices are in the tank or it's a great time, I will get that cash and I can count on that cash. And so that's where it becomes a safer, more reliable source of income than if you were to substitute a dividend for a buyback, like Buffett does for Berkshire. And he
Mhm.
says, well, you can just sell the amount that we bought back and basically give yourself a dividend. It doesn't always work because the market's not always efficient.
No, no, it is not. So then, how does the tax treatment of both impact the potential returns?
Well, dividends are taxed, and depending on how long you've held the stock, it can be a qualified or unqualified dividend. And I don't want to talk tax rates because the tax rates we talk about today could be different 2, 3, 5 years from now. But there are capital gains taxes, which are taxes that you owe if you make a gain on the stock. If I buy a stock for 100 bucks and I sell it for 150 bucks, my capital gains is $50. So you get taxed on that, not as income, but as a capital gains, depending on how long you've held the stock. So if you've held it longer than a year, then you get that long-term capital gains tax. So you're going to get taxed. Government's going to get his one way or the other.
Yeah.
It's just a matter of how are you going to take that tax. In the case of buybacks, if you are holding onto a stock, it is a form of a tax shield. Because if I buy back, if I'm an investor in Apple or something, and let's say they buy back, and my tenth of a pie is now a ninth of a pie, the value of what I own in Apple has gotten bigger, and the company did not have to get taxed by that. I did not have to get taxed by that because I'm holding Apple over the long term. So when a company pays a dividend, the corporation oftentimes has to pay a tax, and the investor has to pay a tax on the dividend. So it's like a double taxation.
Mm.
Whereas in the case of a buyback, there's tax shields there. But again, this is all in theory. In practice and reality, tax situations can vary greatly depending on the company you're talking about, depending
Mm.
on the person you're talking about, depending on how long you've held it. Can depend on what your income is in any given year. It's a lot of factors. So I I do get a little bit, not a lot, but just slightly unnerved about when there's a huge preference and buybacks are always better than dividends, or in this case, listener kind of saying the opposite.
Right.
You get a little unhinged with that because it's not that simple.
Mm-mm. It's not. And I think as we've discovered and discussed over the many years we've been doing this, there's always nuance to most of this stuff. There's not a lot of absolutes in finance. Like this is it, and this is it. I think you have to kind of think through what works best for you in each situation. And you also have to understand that the companies have reasons for doing what they do and how they try to allocate capital as well. Sometimes it's selfishly motivated, and sometimes it's in the shareholders' interest, the motivation to do it. Are there any companies out there that you know of that are maybe 100% one or 100% another, or is it kind of a mixture of the two as far as dividends and buybacks?
Yeah, there's a ton that are buybacks only,
Mm,
and there's a good amount who are dividends only.
mhm,
Westlake is an example, dividend only. Watsco, dividend only.
mm,
Uh, Paychecks, dividend only.
mm.
It's, I don't know. I won't say random, but yeah, it's just there's a wide range.
Right. The thing I remember, I don't remember the specific amounts, but I do remember a few years ago kind of looking at some of the dividend aristocrats, which are, well, they're obviously very consistent dividend payers, that they bought back almost as much, if not more, stock than they did pay in dividends, which surprised me because I just assumed until I looked at the numbers that a company like Johnson and Johnson, for example, was 100% a dividend payer. And when I looked at their financials, I was like, oh, hey, they also buy back shares. Like, oh, that's a shock. So yeah, I think there could be benefits to both and it could be helpful. But I think if you're looking for solely for income, then I would probably say and you correct me if I'm wrong, that dividends would be the way to go as opposed to a combination or looking for companies that are doing buybacks only.
Yeah, uh, because of the nature of also buybacks, the cadence of buybacks can be very irregular.
Right.
Whereas to your point, like a dividend, you can count on a dividend.
Right. Yeah, exactly. I mean, a lot of companies will issue statements that, okay, we are authorized to buy back 3.5 billion in stock over the next 5 years. But that doesn't mean they're going to do it quarterly on a cadence. They may, and some companies do, but others may wait for better opportunities. Some will do it whenever they just have the money. Kind of depends, but it's something they'll throw in the earnings calls or announcements as a way to encourage investors that, hey, we are trying to give capital back to shareholders, and this is what we're planning on doing. And I read it all the time in the earnings calls that, well, we still have 1.2 billion left in our buyback program. Okay, great.
Yeah, I like to see that because it tells me that they're the management's not just going to be reckless with
Hmm.
their future spending. Like there's a plan to get some of this back, and
Hmm.
you're going to see it.
Yep, 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 for sure. I know you mentioned the buff dog earlier. One of the criticisms against him is that he has preferred buying back shares of Berkshire Hathaway as opposed to paying a dividend all this time. And he gets a lot of, I wouldn't say grief, but criticism for not doing. He loves dividends. He talks about how great dividends are, but he won't pay them himself. And so I know people can get a little bent about that particular feature of the buff dog.
Yeah, we'll forgive him for that. He's kind of he's a little bit of one of a kind.
Yeah, he's a bit of a unicorn in that whole capital allocation thing, shall we say.
Right, right. Yeah.
All right. Why don't we move on
I
to
I
oh
did want to actually address the listener says I don't see any advantage in buybacks, and I
mm,
would say that's also wrong because using the example one more time, if you go from 1/10 to 1/9, if the shares outstanding went from 800 million to 700 million, that's less cash that the company has to outlay to make the same dividend payment. So those
um,
dividend increases, which I've heard you talk about on the show too before,
yeah.
those dividend increases that you see, oh, Johnson Johnson raised their dividend 5%. The actual amount of cash that they had to do that was maybe not a 5% increase if they bought back a lot of shares.
Mm,
And that's going to compound and be cumulative.
mm,
So if you're holding a dividend stock, just to beat the horse, but really to try and answer this question, you should not look at a buyback as this is bad because it doesn't fit with what I'm trying to do with this investment. There's still benefits to you. And then obviously we all say in theory we'll never sell our shares, but that's not always ideal too. You want somebody else to enjoy your hard work? Come on.
right.
Maybe you do want to sell them someday. Come on.
Yeah, so true, so true. Yeah, I think to that point, we were talking with Leandro yesterday, and that episode will come out soon. And he one of the things he mentioned I thought was kind of interesting is we all say we want to own every company that we buy for ever, but the reality is if we can find 5 to 6 out of a 20 picks that we do hold, then that's accomplishing something.
Oh, for sure. Yeah.
Yeah, yeah, I love that. Okay, so maybe we can move on to some other questions. So these are some questions I came across on Reddit, and I thought that they would be helpful for Andrew and I to kind of give our takes on them. So the first one is, how do you avoid stock analysis paralysis? So as someone who spends hours a day thinking and studying and trying to find a stock pick every month, how do you avoid something like this?
Well, you just answered the question. I am forced to pick something every month.
Yeah.
That makes it quite easy to not get paralyzed because I have to make a decision.
Hmm.
And that's another one of those kind of untalked about benefits of dollar cost averaging.
Yeah. Yeah, for sure. Yeah, for sure. That's a really good answer. I guess I didn't think about that while I was asking the question. So that's awesome. So what okay, so maybe let's remove that part that you have to make a pick and so that forces you to make a decision. What if you didn't? How would
Yeah.
you how would you tell somebody like me to avoid stock analysis paralysis?
Well, has it been something you've dealt with before?
Yes, I have.
Please explain.
I I will okay. So I I did a lot of work on a company called CrowdStrike for off and on for several years, thinking, because I came to the conclusion a while back that the industry that they're in is going to be continually important. And so I thought it would behoove me to figure out, hey, can I find something that I could take advantage of to try to invest in this sector that I think is going to be something that's going to be necessary for anybody that does business on the internet or interacts on the internet any way, shape, or form. And so I spent a lot of time reading about CrowdStrike, reading about others in the industry, Cloudflare and others, and trying to figure out what do they do, how do they do it, how do they make money, how's this going to work, and how much do I really need to dive into the tech of the actual businesses to understand whether buying this company or that company would be better than the other. And I just went round and round and round, and I could never pull the trigger and make a decision. And it was really, really hard. And at one point I would do all this work, read all these blog posts, read all the financials, read quarterly earnings, and listen to the CEOs talk and think about the valuation, and on and on and on. And I still wouldn't pull the trigger because I didn't feel like I ever knew enough. And so I just basically would not, I didn't waste my time. It was valuable information, and it helped me understand how I should try to do research. But one of the things that I struggled with was, okay, at what point do I know enough that I can pull the trigger on this? And I never got comfortable with it until recently when we did our challenge in our community. I had to think about it more, and I had to make a pick. And
Mm.
so I think by forcing myself to have to make a pick, I chose CrowdStrike, and then to air quote put some skin in the game, I bought a very, very small amount just to have it and to make it more air quote real. So that's how I ended up trying to move past it, was basically because I guess in a similar situation I was forced to do it.
So AAR time, what is your like takeaway from that experience now?
It's a hard place to be, and I guess I don't want to throw on an absolute, but if I was going to dedicate my time to try to find something, I probably would set I would set a time limit on, okay, I'm gonna focus on this for the next, let's say, 6 months, just for giggles. And then after the 6 month period, I'm going to make a decision. I'm going to announce it publicly, and I'm going to at least buy, $10 of it or something, just so I can make myself make a decision and force myself to try to come to some sort of conclusion and not wishy-washy waffle over whether this is I know enough or not.
What was the opportunity cost? Like you mentioned having waffled on it for so long. What could you have done instead of waffle?
Oh boy. Well, I think I could have had more confidence that, hey, I figured out I figured out how Visa works, or I figured out how Berkshire works. I can figure this out, and I know enough. And after talking to other investors about my dilemma, who were all telling me I know enough to, I guess, have enough confidence that I can pull the trigger and try to make a decision whether I want to buy it or not. Because there's always going to be companies or industries that you do research on that just may be completely out of your, not league, that's not the right way of putting it, but it's out of my comfort zone for whatever reason, whether it's evaluation, whether it's the industry it's in, whether maybe something a CEO says gives me the heebie jeebies, something like that could give me pause. But I think if I put a time limit on it, that will give me the freedom to spend the time I feel like I need to do, but also make me mentally, okay, make a decision, yay or nay.
Yeah, I love the time. I love the time thing. I think it's a
Mhm.
perfect solution.
Yeah. Yeah. We were talking earlier about like the 60-second clock. Maybe I need to figure out a 6 month clock that I can put on my computer. Okay, Dave, you only have 110 more days kind of thing. So
Yeah.
hopefully people can find that helpful.
Yeah, I think they will.
All right. So I guess the next question I thought would be kind of interesting would be, how do you find a competitive advantage in a company? How do you determine if a company has one or not?
I mean, how do you pick a stock? We could go down lots of ways to do it. I think you can go as deep down the financial rabbit hole as you like. You can say, I'm going to use ROIC, or I'm going to use revenue growth, or I'm going to use expanding margins. You could go all the way down that path. You could say, I am going to read everything that management has ever said, or everything that they've deemed important in the annual report.
Mm,
Or you could do something as simple as, I'm going to go visit their restaurant and eat there and see
mm,
what I think about it. I'm
mhm,
going to go to their competitor's restaurant and see what I think about. I'm going to do the eye test. Anywhere within that range of things, and I would argue you should do aspects of all three, trying to look at it as a consumer, trying to look at it as an investor, and trying to look at it as an accountant.
mhm,
And those are not going to be a guarantee, but if you do that enough with enough businesses, you start to see some parallels. And for me, you mentioned kind of like the tech thing. I I guess I'm smart enough to know that I don't know a lot in tech. Um, and so when I do something with tech, it has to be, I have to have like a bridge to something I've seen before in another business. Because
mm,
business is business. Like every business has suppliers, they have people they buy from, they
mhm,
have vendors, and they have customers, and they have financial statements. So over time, you start to see trends. Going back to what Leandro said in our interview, you might see a picks and shovel situation in one industry. Valuation is crazy high because everybody loves this picks and shovels company. And then you see a picks and shovels in a different industry that, for whatever reason, Wall Street just doesn't have the same love affair for. But the competitive advantages can be very similar. I say all of that to say that there are many ways to find a competitive advantage, but you can also, as you learn to find them, it can become easier because you can start to see patterns.
mhm.
And to me, that's a great source of competitive advantage finding also, is overlaying it to what you've seen in the past. I recommended a stock a couple years ago that's up pretty big. I want to share that with you so you can see the type of analysis that I do for paid subscribers. Download it for free at stockwriteup.com.
Yeah. Yeah. I love that. I love those ideas of the different frameworks to try to parse it out, if you will. And I think our conversations with David Trainer recently kind of help illustrate that, yeah, ROIC is amazing and it's a great metric, but it's not perfect. And you can find companies that have pretty decent ROIC, but they're still destroying value because their costs of capital are higher or equal to the ROIC. So the growth that you're seeing in the company doesn't always translate to value for shareholders. And so it's not a panacea, like just look here and this is absolutely going to tell you, hey, so and so has a moat. Just because they have an high ROIC, maybe one quarter or one year doesn't mean that the other years they do. And there may be competition coming for them. So yeah, I think having a combination of those different ideas, and I love the idea of going to eat at the restaurant and trying to compare the other ones. I mean, that's perfect. Like we were talking about Chipotle and Cava and some of that, and you went to eat it at a Cava just to see what it was like, because we had experienced Chipotle. You had never been to Cava. I still haven't been yet, so I know I'm probably like, ooh, I'm going to be shunned. But I know it was eye opening for you. And then if you compare that to Texas Roadhouse or other companies, they're not apples to apples, but a restaurant's a restaurant. You bring them food, you give them good service, people like what they pay. It's going to be successful. It's not rocket science. So, it I think all those things are super, super useful. And it doesn't have to be super involved, and you don't have to necessarily call up investor relations and try to get an interview with the CEO to figure out whether the company has a moat or not. I mean, if you can, that's obviously awesome, but I doubt if Satya Nadella is going to be taking my call anytime soon. So, got to figure out other ways to figure that out. But you can do all those things by a little sleuthing, talking to people at businesses you go to buy stuff at, what kind of systems do you use? So like, how does that work for you? Kind of thing. And you can get a lot of great feedback and things like that. And talking to other people in your life and seeing what kind of feedback they give you because they can see things that you don't always necessarily see. And so all those things could be super, super helpful to try to figure out a moat. And if all else fails, you can, you can ask Warren Buffett, what does he think? And they'll tell you.
It's funny. No, I mean, yeah, I love the idea of like asking other people who you would perceive would have a better insight than you into that, into whatever
Mhm.
business you're trying to look at.
Right.
Yeah.
Yeah, I think all those things, if you combine all the things that you were saying, I think that's really good. A really good way to get a sense of whether this particular business or company could have a moat and maybe how strong it is, or if there's competition coming for it that you may not think of. I mean, it's easier to think about a restaurant or retail or something in that case, but maybe if you're working in something that involves CRMs or systems that help people manage their businesses, and you're not super familiar with that, but you know other people that work with those very intimately, you can ask them questions like, which one do you use? Which one do you like? What have you tried? What have you heard about this one versus this one? And all that stuff can be super, super helpful.
Yeah, totally.
All right, so let's move on to the last question. So, do you think the early pioneers of value investing and their style would work today?
I guess it depends which pioneers.
I probably would go with, well, obviously you got to go with Ben Graham because he's kind of the OG of the whole thing. But then
Yeah.
I would probably throw guys like Walter Schloss on that pile, maybe early Buffett, some of those kinds of people. I guess what are your thoughts on how some of what they were doing, how do you think that would translate to today, if at all?
I think it would translate very well. Walter Schloss was just going out and buying whatever was hated.
Hmm.
And by the way, he bought a lot of it. So there
He
were
did.
a lot of hated things that did not work out, but he bought enough that did. And that's when you're dumpster diving, that is key.
Mhm.
Benjamin Graham gets this reputation because of one formula he included in The Intelligent Investor, that he's all about book value, he's all about book value. I actually can point out a spot in security analysis, Graham and Dodd security analysis. He mentioned that it was earnings growth that mattered more than anything else. So this idea that Ben Graham means buy low book value, I
Mhm.
think is a misnomer, because if you go back to his foundational teachings, he was talking about earnings per share.
Mhm.
Earnings per share growth is earnings per share growth, and it turns to free cash flow for most companies. That's as much as where we try to derive value as everybody else.
Mhm.
So I totally think it would work, especially in Graham's case of him understanding that the market is not some all-knowing place of geniuses. It's a pigsty where people are just throwing roses around
Mhm.
and just following their emotions is not the end all be all of value. And I think he would do great finding companies that are overlooked.
Yeah.
What about you?
Oh, I 100% agree. I think to your point, some of the book value and maybe some of the earlier formulas may not work because the way businesses operate has changed. And there, you could argue, are less capital intensive than maybe they were back in the day. And so that is an adjustment that would have to be made. But to your point, the technology that we utilize today has obviously different than it was in 1925, but human nature hasn't changed one iota. I mean, we haven't evolved in thousands of years, and so why would we evolve in 100? So the way we think and the way we behave and act is exactly the same as it was during Ben Graham's time or early Buffett or during Walter Schloss's time. And to your point, they understood those behaviors quite well. The idea of trying to find unloved companies still exists today. People talk about contrarian investing all the time, and that's exactly what Walter Schloss was doing. Yeah, he was doing it a different way, but he was going and trying to find the things that nobody else wanted to talk about. We talk about this all the time, but everybody and their brother loves investing when companies are going up, but nobody wants to buy them when they're going down. And we don't have to look that hard or that far to see how hated Meta was not that long ago. And now everybody loves it and talks about how great it is, but it's the exact same company it was 3 years ago. And Mark Zuckerberg hasn't changed, and what he's doing hasn't changed, but our opinion has changed because of the price. And so the idea of trying to find underloved, undervalued, out of favor companies and buying good companies at a decent price was in 1932, and it's still in 2025. So I think these guys would do just as well, if not better. I mean, Buffett has said several times in his shareholder meetings that if you gave him $1 million, he could earn 50% a year today.
Yeah.
So, I mean, I wouldn't bet against him. I mean, that's pretty that's pretty aggressive, but he's obviously got a lot of confidence in what he does. He was killing it back when he was doing the whole dumpster dive thing, and he's still killing it. But yeah, I wholeheartedly think that they could do great today.
Do you think that there's a narrative that most people think that's not the case?
Yeah, I do. And I think it, to me, it probably more revolves more around two things: the book value idea that you mentioned, and then number two, the outdatedness of a good portion of security analysis and air quote the intelligent investor. Not necessarily in the information or the knowledge that they're trying to teach, but just some of the references and maybe the language, so the way it's written is not contemporary. And so I think that turns people off. I mean, I'm not going to lie, security analysis was a hard book to read, and 200 pages of railroad bonds was a challenge to get through. But there's unquestionably oodles and oodles of valuable, up to date information that hasn't changed in all the time since they were published. So, to me, that's I think why the narrative is that they're not really relevant anymore.
But they didn't have the internet, the all-knowing internet.
The all-knowing internet. Yeah, right. Because it's on Google, it has to be right.
Right, of course.
Yeah. So I think if you think about that real hard, or even not even really that hard, you'll realize that what was valuable back then is valuable today. And all you have to do is go back and read something from history. Even if you read an old Michael Mauboussin paper from 1998, and the stresses and the problems and all the things that they were talking about back then are exactly the same things that we're going through right now. It hasn't changed. The names have changed, the places have changed, and maybe the dollar values have changed, but the stresses and the what are we trying to find and how do we do better at this hasn't changed a bit.
Does that depress you at all to think about that?
No, I mean, I mean, if we want to get philosophical here, it could be that it's a little disappointing that we haven't evolved from those. I want petty is not the right word, but maybe the same hangups that we had in 1995 are the exact same ones we have in 2025. That hasn't changed, and the frustrations and stresses that you have trying to invest in the market haven't changed, but maybe the names and places have changed, and so that I mean that's maybe a little disappointing. But if you're a student of history at all and look back, how the Greeks and the Romans behaved is not that dissimilar to how we behave today. If you look at if you look at elections, for example, you can find horrible propaganda and graffiti from Greece and Rome. And then you fast forward to Abraham Lincoln and you go to the museum in Springfield and see all the horrible things that people were saying about Abraham Lincoln, who is now arguably considered the greatest president we've ever had. And then you fast forward to all the stuff recently. We haven't evolved. We haven't changed one bit from
Right.
early couple thousand years ago to today.
Do you think that lends credence to the idea that somebody could take the early teachings of Graham and make money today?
Yeah. And we're doing it right now. You're doing it right
Yeah.
now.
Yeah.
You know, you've adapted some of the things to fit you, but a lot of the basic concepts and ideas are things that you've been using to make money. Warren Buffett has been using to make money. Toby Carlisle has been using to make money. I mean, yeah, I absolutely think it's viable today as it was back then.
What do you say to somebody who is discouraged that Maybe they like the idea of value investing, but it doesn't seem like it's done so hot, especially this past year.
Well, there's a couple things. Number one is you have to consider that the market is a complex place. And when you're investing, you have to understand that there's going to be ebbs and flows to things. And if you look back in the 1970s, if you weren't investing in a Nifty 50, then you may have struggled for a while. But over the course of a 10 or 15-year period, you would turn out just fine compared to the people that may have been buying and selling the Nifty 50 back in the 70s. If you fast forward to the late 90s, if you weren't buying big on all the tech stuff right into the bubble bursting, you were going to underperform mightily. And so I think when you think about investing, you have to follow what you're comfortable following. If you're buying all the Mag 7 companies and that's keeping you up at night, then maybe that's not the best fit for you. And you got to figure out what are you comfortable with, what fits best with your life, and try not to get too bogged down in if you're chasing returns, I guess is the best way of putting it, then I think in the long run, you're going to do yourself a disservice because you're going to have to adapt every single time something else changes. And that's a really, really hard place to be as an investor. The game is already hard enough, like way hard enough. And trying to decide, okay, is this what I need to do? Or is this what I need to do? Or is this what I need to do? If we think about look at all the evolutions that we've seen since the pandemic in the last 4 or 5 years. It's been all over the place. And historically, if you look at the last 2 years of the S&P 500, those kinds of returns are unheard of. And the likelihood of those continuing over the next 5 to 10 years is pretty slim. And so if you're trying to follow just investing in, let's say, just the Mag 7 companies, I'm not saying any of them are bad investments or this is a bad way to do it, but if you follow them, at some point, they won't be the thing. And if you look at the history of the stock market, you can unequivocally say that every 10 to 20 years, there's a rotation in who are the big leaders. If you go back 20 years and look at the top 10 companies in the S&P 500, I believe there's only two that are still in the S&P 500 today, Microsoft and Apple. That's it. And so if we go fast forward another 10 years or 20 years, it's unlikely that all these same 10 that are there now are going to be there. There may be a couple, maybe three or four, maybe. I don't know. But the likelihood that all seven of them are in the top 10 in 20 years, unlikely, very unlikely. And so I guess a long-winded answer to I think you got to stay true to what works for you and what you're comfortable with. And there's lots of great ways to make money. There's lots of roads that lead to Rome. You just need to figure out the one that works best for you. And I think value investing in the form that you and I try to employ is the one that works best. But I'm biased about that too.
Yeah, that's all very well said.
So hopefully that helps. But yeah, just keep rocking, stay true, don't give up.
Yeah. Any final words?
um, I think the San Francisco Giants are going to come in fourth in the division this year. That's my prediction.
Well, at least there's only one way to go from there.
Right, that's up.
Those kinds of baseline exceptions.
They're unquestionably better than the Rockies, but the rest of the teams in the division,
yeah. Oh, that's true. Yeah, I forgot about the Rockies. So
Yeah.
you could potentially get worse from here.
They can't get that worse. That's like dumpster diving at its finest.
So being a Giants fan this year is basically being a value investor.
Kind of. Yeah. Yeah. I'm in it for the long term. And I understand I'm not going to win every year.
Yeah. Mag 7 can do their thing for the
Yep.
next. Yeah.
Yep.
And then after that, they gotta move over, right?
Right. Exactly.
Time. Yeah.
Yep.
Love it. That's going to wrap us up for today. We hope you enjoyed this show. You can reach out to us anytime. Newsletter at einvestingforbeginners.com. We love to get your questions and answer them on the air. If you are struggling out there and you need to take action, don't delay. Connect, learn, and grow with Value Spotlight. Peace.